Welcome. This is Power Trading Radio Live. Power Trading Radio Live, fueled by Online Trading Academy. For more information on the show, visit us online at powertradingradio.com. Now, here's your host, Merlin Rothfeld.
Hello, everybody. Welcome back to Power Trading Radio. It is your weekend edition. My name is Merlin Rothfeld. We're sitting here with the Ambassador of Opportunity, John O'Donnell. Welcome back, John.
Thank you, Merlin. Good to be back.
I was talking to some people the other day. I was talking about centers. I was correcting myself, as I like to do when I make mistakes, as we all should be doing. And I've been making a gross error for about the past year. Do you know what that error was?
No, what?
I've been saying that there were 50 physical brick and mortar campuses of Online Trading Academy.
Yeah.
There's 48. I stand corrected. And the good news is you were actually at one of those the last couple of days. Where were you?
Yeah, was it the 48th or is it now the 49th?
Yeah, no, I think 48. I think it's the 48.
So it's all inclusive of your new number.
I think so. I'm all messed up.
Well, I was in Chandler, Arizona, and we have which is a satellite center to the one in Scottsdale, and it's absolutely a fantastic team over there. And we went over there. And we had a wonderful grand opening event. Gene came with me. And we had a lot of Power Trading Radio fans and graduates of Online Trading Academy Phoenix Metro show up. And we had a grand evening. And Merlin, everybody was asking, how you doing? You doing all right?
I'm great.
And they were asking about you. And so you got a lot of fans in Phoenix.
A lot of love from Phoenix. Well, thank you. I wish one of these days, I hope I can go on a tour. I was thinking it'd be fun to do like a Power Trading Radio tour and go to all 48 centers, but I guess it's just not in the budget out there yet. So maybe one of these days I'll be joining everybody on the road.
Oh, you mean on the company's nickel?
Hey, I'm gonna do it on my own time. Come on.
Okay.
Anybody got time for that? All right, quick shout out to our YouTube followers right now. We've got Gayer, we got Joe Romo. Hello, I haven't seen you on here before. We've got Deep Truth, Ruben Landon-Dante. And that's an Online Trading Academy's Power Trading Radio YouTube channel, which is normally the talkative one. It's quiet out there today. You guys are usually the vocal ones. Get out there and say hello to each other. Send in some questions, and hopefully we'll get them all answered on today's show. Let's see. Do I want to do the... Okay, I'll make one quick announcement. Jason, you had it up there earlier. Go to otacademy.com. That's the one. Yeah, share that screen with everybody. We do this every year. It's kind of become a tradition, which is... There are a lot of different things which are going to be moving the markets next year. We all know that. There's been a lot of things which move the markets this year. And we try to, condense them down into the big groups and really boil it down to 4 key things we think are going to be major for the markets in the next year. So on December 12th, which is going to be next Thursday at 10 a.m., we're going to be doing a webinar called 2020 Vision, the top 4 economic events that could impact investments in 2020. You can register that for free by simply clicking on that link at otacademy.com right on the front page, or go to webinars. You'll see a little bit better description about what that's going to be. I won't let the cat out of the bag on what the 4 are right now. We've got them pretty locked down. Just because you're not in the webinar, John, what do you think are going to be the major things for 2020? I won't weigh in on mine. I'm just curious what your thoughts are. Give me a couple of things that you think are major for 2020.
How the election goes.
Okay.
Number 1, how the tariffs go.
All right.
Is the Fed going to stay accommodating or just, kind of keep everything stable as far as the availability of cheap liberal credit?
Okay.
They say they're data dependent. They need to kind of
prove that.
Show up and prove that.
I think they're more. Goldman Sachs wants us to cut rates. Okay, we'll do that.
And I'm very concerned about the corporate bond market. I think it's going to have a big impact. Matter of fact, I'm kind of targeting the corporate bond market, the weakness in the corporate bond market, as the potential catalyst to maybe even trigger the next recession, which I don't think is going to be in 2020. I think the next recession is going to be 2021.
John and I agree on something. That's amazing.
We do?
I think 2021 is going to be the year where we just go, this is nicht sehr gut.
What about the other 3?
No, you're wrong on all those, for sure, definitely. No, I think with regards to those 4, yes.
Those are big impact events.
Without a doubt. I mean, there's all sorts of other things we could look at, and I would encourage you guys to tune in.
You say those for your webinar, but but those are 4 big ones. They're gonna have some skin in the game, those 4.
Yes, they are. If you'd like to join that one, of course, it will be interactive. It's going to be probably about 30 to 45 minutes long. You can register at otacademy.com. Simply click on that link at otacademy.com and register for free. Share it with your friends. It's always a fun little one. We try to do it every year. And, of course, at the end of the year, you guys can all poke fun at me and say, well, that one didn't have a big impact, or it did. Fortunately, the ones we did last year for 2019, we were right on all of them, and a couple of them were very, very big movers, so we'll do a little review before we start. All right, let's go to today's markets. And I had some visuals up here. We may have to real quickly bring those ones back up. There's a couple things that we want to talk about. Number one, obviously, we want to talk about the jobs report that came out today. That was critical for our market move today, which vaulted it to all-time highs, went the exact opposite of where I thought it was going to go today. I actually thought we were going to see the unemployment numbers get a little bit better. We'll look at that in just a second, but since John was talking about the bond market, the accommodative Fed, tariffs, and the election, I thought it might be nice to show you this one. And let me take a step back here and go full screen on this one for you. Here is the balance sheets of central banks. So you've got the Bank of Japan on the top. That's obviously in yen. And you can see this goes all the way back into 2000. So you're looking at 20 years span. Well, I'll call it 19-year span. We're almost at 20 years on it. And they've gone from, it looks like roughly, 40 trillion yen to almost 600 trillion yen in less than 20 years. The U.S. Federal Reserve has gone from what looks to be about 500 million to 4 trillion. And we were about almost at 4.5 trillion, and you'll see a little drop there. And then, of course, the European Central Bank following suit, just like us.
It's 500 billion.
500 billion. Sorry, did I say 500 trillion?
Yeah.
Oh, I'm sorry. 500 billion, yes. And now, of course, you can see just the ballooning of investment since we had our financial crisis back in 2007, 8, and 9. And then the European Central Bank looking just as ominous as all the other ones, with a huge accumulation upwards of almost 5 trillion euros. John, any passing comments on what we're seeing here with these three central banks accumulating assets?
Well, it's unprecedented for the United States, which is the reserve currency of the world, to blow their balance sheet up from roughly 800 billion in an extremely short window of time to 4.3 trillion at that peak. And then they were letting it run off. And of course, I think we've got some other charts to show on how they've re-engaged and started to do more purchasing of government assets, monetizing debt. Looking at those three compared to one another, Merlin, it brings to mind on this chart at the bottom, for those of you that can see our charts. I know on radio it's kind of difficult to do. Look how the balance sheet shrunk at the ECB.
Yeah. You're talking between 2012 and 14 right here?
Between 2012 and 2014. We didn't see that in the other two banks at all. As a matter of fact, they kept on printing. But then they got back in the game in early 2015, and they've ramped it up quite well.
And what do you attribute that to? I mean, because in theory, when you have this huge accumulation of assets, you should have a pullback. Just like a market has a big rally, then it should have a nice little pullback. We didn't at all. When we were really just kind of held for a second, then moved higher. Well, I don't really recall what it was that caused them to unwind their balance sheets like that.
I guess the powers that be thought the economy was doing pretty well. They didn't need to goose the economy with more cheap credit. They didn't need to monetize. Probably what it was, it's kind of reversion to the mean. If you were to take those and smooth those out, that 11 and 12 problem was where we had that crisis in the European banking system, with Greece getting in trouble, and we had several banks that were in trouble. And I guess they kind of just really ramped it up. So if you look at the dip, starting in early 2013 through 2014, why don't we just kind of call that reversion to the mean?
Yeah, I think that's...
You see what I'm saying?
Yeah, absolutely. Okay, so let's keep this up here, Jason. I want you to, if you wouldn't mind, Jason, highlight the hard right edge. I don't know, just draw something yellow or whatever you want around it, just to highlight that hard side of this chart for viewers out at home. There you go. What's interesting about this is you guys notice something different here. We have Japan continuing to accumulate assets, not really any drawdown. The European Central Bank kind of flattened out. And what's noticeable is starting in late 2015, the U.S. Federal Reserve really was unwinding their balance sheets. And you can see it did it fairly predictably, right? We saw it drifting down. I want you guys to notice the magnitude of this spike up that we had here the past couple months. So Jason, go to our next visual I gave you, which is the pop up here. here is the Fed's total balance sheet in billions, right? So you're looking at $4.06 trillion. We were at 3.76 just a couple of months ago. We go back actually to September 1st. So really in 3 months, we've added on roughly $300 billion worth of balance sheet investments for the Fed. John, what is going on, and why this sharp turnaround?
That's the Fed's fear of the impact of the uncertainty in the economy.
Yeah,
and
the repo market.
Well, the repo market is part of it, and obviously there was this big dip last year, if you recall, and there was great criticism of Chairman Powell, which was the catalyst to cause what they felt was the cause of the sell-off. European banks have continued to cut their rates, and there's been a lot of jawboning by President Trump to Chairman Powell, trying to get rates lower. As a matter of fact, he's kind of been an advocate for negative interest rates. If you really,
he didn't sound opposed to it at all. That's for sure.
No, I mean, and he keeps keeps making fun of Chairman Powell, telling him he doesn't know what he's doing over there. But the Fed has been pretty strong about enforcing their independence. But I think this tells us that Chairman Powell kind of surrendered to the bullying from the president, as a matter of fact, to goose the economy, getting ready for an election year that's coming up. And he wants a strong economy and to get reelected, which is quite common.
Yeah, I agree. I think that this tells us what is necessary to maintain the market as people are enjoying right now. When we look back at that chart just a couple minutes ago, this is the reason why we're seeing such robust moves in the market. Now, of course, there's other factors out there, but this is definitely an accommodative central bank, not just here in the U.S., but around the world. So when you hear President Trump or any other politician, Republican or Democrat, say that other countries are starting a currency war, yeah, notice that it really was the U.S. markets here. We started this whole thing back in 2008 with massive balance sheet accumulation by our central bank. Of course, the other banks have done it as well. It's to keep up with the Joneses type of world. So this is the beginning of that currency war. It's going to continue on. I don't see it changing. What makes me nervous is how fragile the U.S. markets will be if the Fed does not continue to support. I know we have a couple of viewers out here that are always pounding the table saying, it's the Fed, the Fed's so great, the Fed's so great. Yeah. They're what's causing this big market rally, but at some point we have to look at it and say, is this infinite well of capital going to continue to push these markets up? And if so, what ends up happening? To me, it's like an engine running at redline. It's great, but all of a sudden, something could go wrong, which causes that engine to overheat and shut down.
Well, the question has to be, with Fed funds rate being where it's at today and being the balance sheets are blown up so extensively, what are you going to do if there's cracks in the plaster in the corporate bond market?
Yeah.
And, they're running out of power if they want to stimulate when the next recession comes, what tools do they have to stimulate? You can't monetize debt infinitum. I mean, come on, it's kind of ridiculous.
I mean, we haven't seen it fall apart yet.
Well, we haven't yet. It reminds me of the guy that jumps off the 90-story building and at the 30th floor he says, everything's okay so far.
I haven't heard that one, John. That's pretty good. I like that. All right. Cool. We have a lot more to talk about. I want to go to the jobs. I want to go to economic data. I want to give a quick shout out to a lot of the viewers out there. We have a newbie joining us today. Where did that one go? I saw it on the Online Trading Academy YouTube page. Lincoln Fararesi. All right. Sounds like a nice Italian name. He's new to Online Trading Academy, taking his new student as of today. So welcome, Lincoln. Great to have you on board with us. Jeffrey, you sent in a funny comment. So we talk about sometimes when price hits a level and it keeps hitting it and hitting it and hitting it. It's kind of like that jackhammer on concrete, or a hammer against glass, and eventually it's going to shatter. This is a pretty funny one. I like this, Jeffrey. He says, instead of a hammer on glass analogy or jackhammer on concrete, we should use the new term, like a ball bearing on a Tesla window.
Oh, that's a good one.
I like that one. That's good.
Yeah.
Should we try that again? Sure. Damn. All right, guys, let's take a quick break. When we come back, I got some great questions. Gayer would like to know about what we think would happen if Deutsche Bank were to collapse. Also want to talk about those jobs numbers, which are very interesting. So if you have any comments, things you'd like us to address on today's show, join us on our social media on YouTube right now. You can join the discussion with the people. You got Lincoln and Ruben and Peaceful Love. Well, peaceful. We've got Peaceful Love with us today, John. We like having Peaceful Love with us.
It beats the alternative, Merlin.
It definitely beats the internet. We got Joe Romo. Say hi to your brother Tony for me. And, of course, all our usual gang, Gizmo and Ruben as well. Oliver, welcome back, my friend. Send your comments on our YouTube channels, Online Trading Academy, or on Power Trading Radio's YouTube channel, or send them in at powertradingradio.com. We'll be right back after a short break.
By the way, there's a
There are lots of different reasons why I teach. I know what it's like from the beginning because I was a student here. I love going around the classroom and you get those aha moments where, you know, slowly those light bulbs switch on as the week unfolds, and for me it's magical.
I've been telling students for years that I derive professional satisfaction from sharing my knowledge about trading. I grew up on the floor of the Board of Trade. My father was my first mentor.
I like to see people run, and in order for them to run, they need to walk well first. And for me to help them build a solid foundation and then watch them go forward, that's something that money can't buy.
What these people are now realizing is the freedom that they have always wanted to achieve. And it's a quite humbling and honorable experience to be able to know that in some small way I have contributed to them.
The students make the academy. And I meet wonderful people from all walks of life, and they always have a story to tell. And the story is always interesting.
Being able to explain things in a way where the light bulb goes off, and that gives me the chills. It's a wonderful experience to see that growth in somebody else and that you're a part of that. It's magic.
The students, I really want to enable them to bypass the challenges that everybody goes through.
There is rather a selfish aspect, and that selfish aspect is I have found more of me as a person. Just a self-discovery.
And in every class that I teach, I get to share my knowledge, and I get to see each and every one of my students learn how to trade in a bull market and in a bear market and even in a sideways market. And each time I see that student of mine take that first trade, it's such a rewarding experience. It's awesome.
Welcome back to Power Trading Radio Live and your host, Merlin Rothfeld, with today's special guest.
Hello, everybody. Welcome back to Power Trading Radio. Is your weekend edition. Hope you had a great day out there. Certainly, you were probably rewarded by the announcements today. There was a lot of jobs data numbers that were coming out that really vaulted this markets to highs. Of course, there's always the political side to it, but the jobs numbers look pretty darn good. So I thought we'd start this segment by taking a peek at what those numbers are, show you guys some charts just to put it in perspective, because if I were to read these facts for you, which said unemployment rate was 3.6%, and it was expected to stay at 3.6%. You're like, okay, well, fine. But you got to put it in perspective with the big picture of where we've come from. I actually thought we would see unemployment numbers go up a little bit. I was actually thinking we'd jump to 3.7 and have a little bit of an increase. We actually dropped on unemployment. We came to 3.5, so this was cheered by the markets and showing an even healthier market than thought. Jason, bring up that U.S. unemployment rate. I wanted to bring this one up and show it to you guys so you can see the last 20 years of how this looks. Obviously, back in 2000, we were right around 4%. We spiked up in the mid-2000s up to around 6%, sold off, and then we had that parabolic rise in unemployment in the U.S. Now that brought us to just over 10%. We had 2 months we were over 10%, and that's on that U3 rate. And then all of a sudden, we did quantitative easing, the Fed stepped in and started bailing us out. We had a lot of other Operation Twist and things like that. And you can see we've fallen from 10 to a point where the Fed said full employment was 5.5%. That would be right here where Jason's moving his cursor back and forth. Of course, right now we are at 3.5%. Things look great. Things look healthy. What do you think, John?
Well, let's give the disclaimer. This is the U3 rate.
Right.
We haven't talked about the U6 rate. There are multiple ways to measure this if you want to be a little more transparent. But this is the one that politicians want to use.
It sounds better.
Because it's the best one.
Right.
Right. But then there's another way to measure unemployment, which takes into consideration that group of the gainful, capable people to be employed that are either underemployed or even have stopped looking for work. They're just basically discouraged, and they've, for whatever reason, maybe their skill set isn't appropriate for today's marketplace. And that number is still way above 6%.
Yeah, 6.9 is what the U6 rate is. And of course, there's different grades there, guys. I'll read you the definitions here because it's kind of funny. The U3, which is what the Fed reports to us, is the total employed as a rate of the civilian labor force. That's the official one. The U6 is defined as total unemployed plus all persons marginally attached to the labor force plus total employed part-time for economic reasons as a percent of the civilian labor force plus all persons marginally attached to the labor force. What do you mean by marginally attached? Are these people just said, you know what, I've had it, I just don't want to, I'm tired of looking for a job, there's nothing out there for me, which of course is a lie because there's so many jobs.
It might be considered part of the gig economy, you know, where they're working a couple of days a week or they're working nights or, you know, it could be that they used to have 40 hours a week of employment, and now they've only got 30 hours a week of employment. I mean, it could be a lot of different factors, but it's not the, you know, full-blown employment with benefits. And by the way, it isn't just wage, the amount or the percentage, it's also what is the wage rate or the income for those hours of labor. So there's a lot of factors that go into that. But this is the one the politicians want us to see.
Regardless of whether it's the U3 or the U6, if we were to put, and I don't have access to the U6 data in this format, or I would show you guys what that would look like, because my guess is back in 2009, the U6 was probably somewhere around 15 to 20%. Right?
I think it was a little over 14.
14, okay.
But that's it still is halved from where it was.
Which is great. You know, this is a sign that
I happen to believe the U6 gives you more information and is more transparency as to what's going on in the labor market.
Now, there are other factors out there. Of course, this chart to me is fantastic. And if you're the central bankers, you're looking at this going, see, this is why we do quantitative easing. If we didn't do this, we wouldn't be there. And we could always make that argument. There's two things I want to look at. Number one is non-farm employment. This is the numbers that came out today, which really skyrocketed the markets. There was 156,000 jobs created in the previous report. They were expecting it to jump to 181,000, meaning you're looking at an increase of about 25,000 jobs in the non-farm employment area. Now, we actually came out at 266. So instead of not just a 25,000 job gain, we ended up with 110,000. It's over 4x better than expected. You can see that on the hard red edge of this chart. You guys can see this little orange box, or whatever, that gold box. That's what the expectations were. We came way higher than that with regards to the number of jobs. So that was a very positive sign for the market today. Of course, most of you who were long enjoyed a great gap up in the markets. Now, let's look at one more chart here Jason had ready for us, which is the labor force participation rate. Now, this one goes way further back. We've been looking at charts from 2000, and I apologize, they're not all the same distance. This one goes all the way back into like the 1950s. Back in the 1950s, you were looking at under 60%. That was probably because of the Leave It to Beaver type of era, where the wife stayed at home and cooked and cleaned. Now we have two-person working households. And in the 70s and 80s, we really saw that spike to up over 60, close to 67% labor force participation rate. But John, it's been declining. How does this play into your analysis of jobs in the U.S.?
Well, David Stockman came out with a report on this recently that I had the opportunity to read. I didn't know we were going to talk about this today. And
I just want to surprise you with topics.
Another Merlin mind melt moment here. Also, Don Boudreau published something, which I sent you a copy of. He published it in the Philadelphia Tribune. And he applies it to an aging population. He applies it to people wanting more leisure. That leisure is looked at as good. So people want to have more weekends. People want to have more leisure things to do with their life, not work as hard. And these are choices that people are making in their lifestyle. These are mega lifestyle changes. I did a little bit of research on this, and I wanted to figure out what the labor force participation rate was after World War II. It was 84%, Merlin.
Wow.
Yeah,
okay.
Way up to 84%. So then it had that big drop into the 1960s, and then we had this rally up through 2002. But this is telling me that the population's getting older. We got a lot of baby boomers. Those that can in the baby boomer category are staying in the workforce longer, and they're favored by employers because they have a lot of experience. But they're going to have to, many of them, and I think Online Trading Academy perhaps has been the beneficiary of this, many of them are choosing to drop out of full-time employment or retire or go into permanent or residual retirement, which is part-time retirement, and learn new skills. And I think if you look at the demographic we serve, Berlin, which is the sweet spot of who we've served over the last 20 years, it's mostly in that baby boomer category. Right?
It shouldn't be. I mean, it really should be people who want to learn how these financial markets work at all levels.
Well, it should be everybody, but the matter of the fact is, what do you have to have? You have to have time, you have to have money, and you have to have need. And if you think about the baby boomers who have accumulated some savings or not enough savings, they need either supplemental income, boost up that income, or they need to take what income they do have and make it grow at a faster rate. And that's going to take skills and support like they can get at Online Trading Academy. I mean, I wish the millennials would get engaged in this.
I think they are. I think we're seeing more and more come in the class. I think that average age is dropping in the classroom experience. One other thing I want to look at here, Jason, go back to the U.S. unemployment rate. And I'm just curious, I don't remember any of this from when I was getting my economics degree, but obviously when you have a lot of people sitting on the sidelines in an economy, that means that there's the potential for the economy to do a lot better if those people come and be a part of that workforce, if they really start putting their efforts and working. Now, we saw a big economic decline, which is why we saw such high unemployment rate back in 2009, 2010, but we had quantitative easing. That stepped in 2009. All of a sudden, it started to get a little bit better. Employers felt more confident. They had access to cheap capital. Now, all of a sudden, unemployment starts to drop. Our economy gets its footing again. What happens when a pendulum swings the other way? Because right now we're at a point that historic lows with regards to unemployment rate. And if we're looking at the workforce as being that piece which helps fill jobs, our economy is growing and expanding, which it visibly has been doing. If there aren't more people to fill those roles, then unemployment, or the amount of unemployed people becomes an issue, because now you don't have anybody to continue pushing things up. You don't have more people to fuel or to feed that engine, if you will, of growth.
Well, in order to consume, you must be a producer first. And if you look at your consumption pattern, Merlin, you have to produce first. You have to have some income. You get your income, generally speaking, through wages. For an employer, you produce goods and services that the market wants. You're compensated for that. From that, you have a consumption pattern that you can finance. So first thing that we need to do, we need more. So the fact that we got a lot of people working, that's good for the potential of further consumption.
Right.
Okay. But take a look how that thing spiked from 2007 all the way up into 2010. That's what happens in recession. That's where you see this spike in unemployment, which went from what, 4.8 to a little over 10.
Yep, 4.3.
And that's why you see a tremendous slowing in the economy, because those people aren't working. And again, if you don't produce, you can't consume, unless you're going to consume your seed corn.
Consume your seed corn. That was a new one, a new twist to a topic on the show. All right, I was going to take a commercial break, but I think we should just keep on rolling through here. Right, okay, so those are some of the headwinds. Obviously, you're looking at this unemployment, which I think looks great for us on paper. At some point, though, you got to go, well, we're creating jobs, but now we don't have people to fill it. And of course, you have people that just never want to work anyway. They want to take free handouts. That's just part of America. There's also...
And then you have people that are getting displaced by disruption, robotics.
Sure.
And that people that are making lifestyle choices to take early retirement. How many people do you know that would like to retire when they're 50 years old?
I got a goal on that one.
There you go.
A few more years, John. Let's go look at one more. So we've looked at this Fed central banks rates, the consumption and the assets on their balance sheets, which has been very interesting, especially with the U.S. central banks. We also looked at the unemployment, some of the jobs data, which was great for our markets today. The question is, how long will we see this unemployment rate stay this low? It feels like setting up to be a pretty perfect storm, especially with some of the debt market stuff. Now, the other piece here is a political hot potato, right? And that is going to be the U.S. federal minimum wage. Now, in theory, if we go from $7.25, which is what it's at right now, and jump it up to $15, well, hey, people are going to be spending a lot more money. It's going to be great for the economy, but remember, that money's got to come from somewhere. So employers who were, let's say, had $1 million worth of payroll would now be potentially paying even more if they were hiring all their employees at minimum wage. I brought this chart to show you guys visually what has happened historically. So back when I was working in my early youth, $4.25 was the minimum wage, but you see there was an incremental move up. We went from $4.25 in 1995 to $5.15 in 1997. Now, it stayed there for a long time, and then really the big bump happened in 2006, right? From 2006 to 2009, the minimum wage rate jumped about 50%. Went from 5 1/8 to 7 1/4. Now the talk is, John, going to 15, right? So that would be a 100% plus jump up in this. Do you think that that's crazy? Do you think we should incrementally move up minimum wage?
I think the market should determine wages. If I were king for a day,
if I were king for a day,
I would abolish minimum wage laws completely, and I would let the market, supply and demand, determine wages. Wages rise and will rise when there is rising productivity, which means you have the right set of tools, you have the right workers to execute with those tools to raise output. That being said, I think to jump from 7 1/4 or whatever that number is to $15 is too aggressive. I think it will cause job losses. I think there will be some people that just don't have the skills to give an employer $15 an hour of output.
Right.
It's one thing just to throw a number out there. It's that the labor force that you're hiring, especially for the young people just trying to get a job and getting their first, foot on the first rung of the ladder to improve the mobility of their life through raising their skill set. It will cause a lot of people not to be able to get a job, and it will be an incentive for more robotics faster. And the best example of this is what's happening in the fast food industry.
Right.
Since wages have jumped from $5.50 an hour to $7.50 an hour, all of a sudden you're seeing every major fast food chain exploring putting in robotics, automation, automated cooking equipment, and automatic order entry equipment, and you're going to see those jobs are cannibalized by too aggressive jumps in the cost of labor.
Well, it's certainly one of those topics we'll be hearing more about as the elections start to heat up. Minimum wage will be one of those topics that's not going to go away. It seems to me like, it probably could be bumped up a little bit, but jumping from 7 1/4 to 15 is one heck of a jump. And just looking back over the last 30
there's
years,
always unintended consequences.
Sure.
Sounds wonderful.
Well, anytime you change something that much in a short period of time, you're going to feel the impact very suddenly.
And what about those people you've met in your life that are either not motivated to give an employer $15 an hour worth of output? That's just not economic. It's not sustainable.
Right. Depending on the job, of course.
Of course. And by the way, depending on the individual, that doesn't mean they don't have the potential to raise their skill set to do that, but there's a whole group of people that don't.
Yep. All right, last topic for the day. Unless you guys have some more stuff you want us to discuss, we'll bring it up. Gayer wants to know, what do you think would happen if Deutsche Bank collapsed? We got one of the biggest financial firms in the world facing major issues. A lot of people lumping it into the Lehman Brothers type of category. What do you think would happen?
I think it'd be nationalized by the German government.
Really?
Yeah, that's what I would think would happen. What do you think they're going to do? Just close the doors? Are you kidding me? No, it would be, remember, you have counterparty risk. The ECB will be involved. The German government will be involved. It'll be nationalized. What happened when Fannie and Freddie got in trouble? Basically, it went into what's called conservatorship, which is the same thing as nationalization. And I think it would be nationalized. And think of the counterparty risk to the whole European and American financial system if Deutsche Bank went under.
Yeah, I think that if it does happen, there'd be some nationalizing going on, but I do think what it would do would create some serious shock through the system in all global financial markets and really having people question the big financial firms. Again, we can go back to the whole too big to fail topic, but for Gayer, who's out there thinking, it'd be great, I'd like to see him wipe out my credit card debt. That's not going to happen. Your credit card debt would still be there. Just the firm would change.
No, the credits and liabilities.
You're still on the hook for those, buddy.
You're going to be talking to a different debt collector.
Yeah.
Or you might be in some court proceeding talking to a judge about why you don't want to pay your debts.
But I do see, I don't think you're out of the woods in that one yet. I think it's still a fairly ugly situation going on. There's a lot more to find out, and I think time will tell. I don't think they'll collapse.
Think about when General Motors got in trouble. I mean, what happened? It got nationalized.
Yeah, but General Motors, I mean, I wouldn't say systemically the failure of General Motors would be as impactful as the failure of Deutsche Bank.
We were told the whole automobile industry that 3 million people's jobs were at risk. I mean, that was the whole justification of the Obama administration wanting to nationalize it. Really, what I think could have been done, I don't think it needed to be nationalized, what could have been done, and when it could have gone through a bread and butter Chapter 11 proceeding, the balance sheet would be, the whole finances of the company would be restructured. Unsecured creditor debt would be wiped out. Secured creditors would get the assets. Existing shareholders would get wiped out. But the old debt holders would become the new class of shareholders.
Right.
You'd give a bunch of shares to the union to keep them happy, and you'd keep operating. And the brands would still be alive. The domain dominance and know-how to make automobiles would still be present.
Yeah. I think what would arise from that situation would be very akin to what we saw in the U.S. financial industry at that same period of time that Lehman Brothers went down. Lehman Brothers went down for a specific set of circumstances. Some of the other major financial firms didn't have that much leverage. They weren't that over-leveraged, and they were in a much safer position, yet almost every financial firm suffered at that period of time. So I think if it does happen to Deutsche Bank, it will present some amazing buying opportunities in these financial firms. And of course, not in Deutsche Bank, but I think if you look at maybe some of the other ones that are going to ride down with it, there will become a point where their value is going to be a great, great discount. So, you look at Warren Buffett. Warren Buffett was huge in the purchase of Bank of America shares back at $5 plus warrants just to help them out.
Goldman Sachs, too.
And as well as Wells Fargo, he was also very big on. So I think if it did happen again, we should learn from what Buffett did, which is when we see some of these other major international banks crash like that and their value of their share price drops 50, 60, 70%, buy it. I certainly would go and do some research on them to make sure they're not in the same situation as Deutsche Bank, but I think it will present some great opportunities.
And Bank of America bought out Merrill Lynch. Bear Stearns got bought out by J.P. Morgan. Wachovia, Washington Mutual, Bear Stearns, Lehman Brothers. They all got they all got a partner, a shotgun marriage,
right.
Underwritten, sponsored by the Fed, and life goes on.
Bail them out. Too big to fail. All right, cool. Hopefully, you got that heard. Tom says minimum wage in Texas is $7.25. That's the federal, so it's everywhere. But you can't hire someone that will reliably show up for less than $11.50. That may be right, and I think you're going to see that in different parts of the country. I mean, can you imagine someone in San Francisco accepting a $7.25 an hour job? That'd be homelessness in San Francisco. I believe they're saying that in San Francisco, like $150,000 a year job is the poverty level in San Francisco because of what's happened with the prices of real estate, et cetera. So $7.25 ain't going to cut it there either.
That individual's probably still living with mom and dad in the basement.
Maybe, but I still don't see $7.25 anywhere in the city. But yeah, there are parts, you can go out to some rural part of Nevada where there's just nothing out there. You go to Spotlight, Nevada, and maybe $7.25 is going to be acceptable there. Maybe that's just the supply and demand of the people and population of those areas. John, you got anything else to add? You can do anything fun this weekend? I know you're to watch football.
Well, I'm going to watch the collegiate conference championships. I'm kind of looking forward to that, and that's about it.
You're going to watch the stupid bowls? I remember when I was younger, it was like you had the Cotton Bowl, the Orange Bowl, the Sugar Bowl. Well, now it's like the Pencil Bowl, the Pro Gaffer Tape Bowl, the iPad Think Bowl. It's like, come on, this is so stupid now.
Those will all come after Christmas.
Okay, I don't know. I just saw some, the cotton candy bowls.
I'm trying to talk to my wife, regardless of who's in it. I'm trying to talk my wife in going to the Rose Bowl. We haven't been to the Rose Bowl in a long time. Have you ever gone to the Rose Bowl?
I have not.
It's quite an
actually, no, I have not.
It's in Pasadena. It's a beautiful experience. And I went to the Rose Bowl parade one time, and I really enjoyed it.
Yeah?
It's fascinating. You would like it too, Merlin. I
don't know, parades. I don't see the point.
Well, what you would like, they have a way you can explore how they make all those beautiful floats of flowers.
That would be cool.
You would really like that because you're very creative.
Me and my creative stuff. Yeah, Gary says buy the drops. Yes, within reason, right? I mean, obviously we don't just buy anything because it's cheap. You hear me hammer on people on the show all the time because they show me some stock that was $50, now it's 30 cents. Like, it's going to go back to 50, right? No, that's probably a crap company. What I'm talking about is if you have a big an investment bank, you can talk about IMI Bank or some major firm out there that's gone from $50 down to $5, and this is a major stable, a critical piece of infrastructure for the growth of whatever country it's a part of. They're probably not going to let that one go away. It's probably going to bounce back. But, there's a ton of stocks that have gone from $50 to 30 cents that will probably go into bankruptcy. We don't buy just because something is cheap in price. We buy something that's cheap in price because it has value, the financials look good, the prospects for the business is good if you're an investor.
You're not talking about the weed industry right now, are you?
Well, there's still plenty of opportunity out there.
There sure are, and
Absolutely.
It's a lot less expensive today.
Certainly a lot less expensive today. All right, let's go to our economic calendar. Jason, bring this one up for us so we can see what's cooking for Monday, December 9th. We're trucking through the month of December, and so far, so good. For the U.S., we've got nothing on Monday, which means we will probably be subjected to some crazy tweet over the weekend, which will cause either a big move down or a big move up. That's just par for the course and just the normal thing. Euro has Syntax investor confidence. You have Canadian dollars with housing starts and building permits. Aussie dollar with NAB business confidence number. So really nothing major there on the announcement front on Monday. We do, in fact, though, have some earnings announcements to speak of. Vail Resorts, Chewy, for those of you who are beholding man's best friend. You've got MongoDB, Casey's General Store, Toll Brothers, and Thor Industries. Yes, he came out of Asgard, and now he has an industrial company here on Earth. Take advantage of those capital markets, Thor. Good for you. Show for Monday. It's a little bit different. Normally it's a stock day. We're going to bring on Rick Wright. We're talking currencies. Global currency markets will be the topic du jour. You want to know more about the euro, the yen, the pound, the drachma, whatever you want to know, let us know. Send it on in at powertradingradio.com by clicking that button that says Power Blast. And of course, you can always interact with us on our social media channels. YouTube, we were always broadcasting live at 3 p.m. Pacific each day. So right now, if you are interested in learning more about anything we talked about, click that link that's showing up in social media. There is a link that will pop up. You simply type in your zip code. It will tell you which of our 48 physical brick and mortar schools around the world are nearest you. Each one has free classes, paid classes, community events, dedicated team there to help you understand how these financial markets work and how we may be able to change them to the better to your advantage. I don't write wording there. I got to make sure I say that properly. Change it to your advantage. How about that?
Sounds good.
Sounds good. That will do it for us, guys. Hope you have a fantastic weekend. Thanks so much for joining us. Until then, happy trading. We'll see you next week.
Peace.
We're out of here.